Welcome back to the deep dive. Today, we've got some pretty dense source material in front of us.
We do.
And we're not going to shy away from it. We're peeling back the curtain on the real engine room of the UK economy, how companies actually raise money, how they structure ownership. We're going to forget all the market noise for a bit and dive into the core mechanics, share, capital, and equity finance. And the sources you shared, they really focus on the fundamental, often quite rigid legal rules that govern this whole structure.
That's right.
The definitions, the safeguards, all the procedures that companies must follow. It can sound a bit like dry company law, but honestly, understanding these rules is the difference between knowing the true value of your investment and, well, just hoping for the best.
Exactly. I mean, when we talk about these regulations, whether it's the fine print on share allotment or the surprisingly strict rules on pricing, what we're really discussing is the bedrock of corporate governance.
And investor protection.
And investor protection, most importantly. These legal frameworks, they exist to protect the capital that's been put into the business and, crucially, to define exactly what rights an investor gets for their money. It's all about stability and certainty.
Okay, so let's unpack this. We've got a roadmap. Our mission for you today is to navigate 4 essential pillars of UK equity. We'll start with the varied types of ownership, then explore the legal mechanics that protect those rights. After that, we'll get into the specific act of actually creating a share, and finally, look at those strict rules you mentioned for how shares have to be priced.
Right. So let's start at the absolute foundation. We need to define how a UK company even raises equity in the first place.
Basics.
The very basics. It's the process of exchanging an ownership stake in the company for capital, for money. A company needs to grow, it sells shares, and those shares represent a slice of the ownership. But that's the simple concept. The law immediately makes it more complex.
And this is where it gets really interesting right away, because the assumption that a share is a share is just completely wrong in the UK system.
Totally wrong.
Our sources point directly to the existence of different classes of shares. We're not just talking about ordinary shares. We're talking A shares, B shares, preference shares. This classification is fundamental. It's where power and payment get separated.
And that stratification is absolutely key. The creation of these different classes is precisely how a company builds its financial hierarchy. These differences are critical because they define varied rights, and they usually fall into 3 buckets: voting rights, economic rights, so dividends, and then rights on a liquidation.
Can you give us a quick contrast? Like, how does a preference share really differ from an ordinary share?
Sure, think of a preference share as something like, well, almost like corporate debt dressed up as equity. It often has limited or no voting rights, but it comes with a contractually fixed dividend.
So a set payout.
A set payout, and it gets paid before ordinary shareholders see a penny. It offers stability, certainty. On the other hand, an ordinary share carries the maximum risk. It's last in line for any payment.
But it gets all the upside.
It gets the full unlimited upside if the company really takes off. That's your classic high-risk, high-reward equity structure.
So the aha moment here for you as a listener is that when you're investing, you're not just buying a piece of the company, you're buying a specific contract.
A contract, yes.
And that contract dictates your power and your place in the queue for payment. It means you always have to look beyond the share price and understand the class you're buying into, especially if you care about governance, because 2 shareholders with the same number of shares could have wildly different amounts of power.
Right. Now, once a company has set up these precise definitions of power and payment through its share classes, those rights can't just be changed on a whim.
They're locked in.
They should be. And this brings us right to the next key point, the governance safeguard, which is the process for altering class rights.
This sounds like the legal defense against, I don't know, corporate abuse. If the majority shareholders could just vote to strip the payment rights from a minority class, the original deal would be worthless.
Precisely. And this is one of the strongest protections built into the UK framework. The sources are clear on the need for a formal, mandated process for any alteration. This isn't just a simple board meeting.
So what does it involve?
Well, to change the rights attached to, say, Class A shares, you typically need more than just a general shareholder approval. You need a supermajority, usually 75% of the holders of the Class A shares themselves.
Oh, wow. So the very people whose rights are being affected get a special, separate veto power.
They absolutely do. It ensures that a hostile majority holding ordinary shares can't just gang up and vote away the protected economic rights of preference shareholders, for instance.
And there's more, isn't there?
There is. The Companies Act even allows a small percentage of dissenting shareholders, I think it's typically 15% of that class, to go to court to have the change canceled if they feel it's unfairly prejudicial to them.
So you even get judicial oversight. I mean, I appreciate the stability that offers, but doesn't that kind of rigidity sometimes hamstring a company that, genuinely needs to restructure to raise new capital or complete a merger?
It can. It absolutely can, which is why the process is often complex and time-consuming. But the why behind it is all about stability and predictability. Investors rely on their rights being consistent.
Sure.
The stricter the rules, the more confidence investors have that the deal they signed up for will remain stable. It stops management from just changing the rules of the game after the fact. The contract you sign on day one is the contract you hold on day 1,000.
That structural protection is critical. Okay, let's shift gears a bit. We've talked about protecting existing shares. Now let's talk about the legal act of creating new ones. This is the moment ownership is officially born, what the law calls the allotment of shares.
Allotment is the specific legal ceremony, if you like. It's the formal resolution by the company to legally grant new shares. It moves the capital onto the company's books and, well, it forges that shareholder-company relationship. But the complexity under UK law comes down to two things. Who has the authority to issue them, and who has the right to buy them first?
Let's start with authority. Can the board of directors just wake up one morning and decide to issue millions of new shares?
Not without specific authorization, no. Our sources are clear. The power of directors to allot shares is often restricted. In many cases, unless the company's own rules grant them that power widely, directors have to go back to the shareholders and get their approval with an ordinary resolution.
So it's a check on their power.
It's a fundamental check, yes. It prevents them from just flooding the market and diluting everyone's ownership without any approval.
Okay, so the shareholders decide if new shares can be created. But then who gets to buy them? I'm guessing if the company's doing well, everyone wants in at the offer price.
And this is where another massive protection mechanism kicks in: preemption rights.
Preemption rights.
These rights are central to protecting existing shareholders from being diluted. Unless they are specifically disapplied by a special resolution of the shareholders, which is a much higher legal hurdle. A UK company must offer any new shares to its existing shareholders first.
In proportion to what they already own.
In proportion to their current holdings, exactly.
Wait, so preemption rights basically guarantee that you, as an existing investor, you get first refusal.
That's it, precisely. If you own 1% of the company and they decide to issue 100 new shares, you have the right to buy one of those new shares to maintain your 1% stake. It forces the company to keep the ownership structure the same.
Unless the shareholders themselves vote overwhelmingly to let it change.
Exactly. They might do that to bring in a big strategic investor quickly, but they have to consciously vote to give up that right. And then, the administrative side is immense. Every single share allotted has to be properly recorded in the company's statutory registers.
Not just a spreadsheet.
Not at all. We're talking the register of members, the register of allotment. Any mistake there, any failure to correctly authorize or record it, can lead to huge legal fights over who owns what. It's not just bookkeeping, it's foundational legal evidence.
So allotment is the moment ownership is legally forged and is protected by two layers. Shareholder approval stops directors from going rogue, and preemption rights ensure you get to keep your slice of the pie. That's a powerful defense against dilution.
It is.
All right, now let's get into the financial mechanics. The part that really determines the health of a company's capital. When a company allots those shares, how is the price set relative to its sort of theoretical floor? This is all governed by these very specific rules about issuing shares at a premium or a discount.
This is the absolute core of the UK's capital maintenance rules. Every single share has what's called a nominal value.
A par value.
The par value, yes. It's a minimum floor, often just 1p or £1 set when the company is created. And it's crucial to understand this is a legal concept, not a market price. But the difference between this nominal value and the price the share is actually sold for, that matters enormously.
So let's start with the good scenario, issuing shares at a premium.
The standard, healthy scenario. This just means selling the share for more than its nominal value. If the legal floor is £1, but the market thinks the share is worth £100, that 99 difference is the premium. And the law is very clear on this. That entire surplus amount has to be put into a specific statutory reserve, a locked box called the share premium account.
Now that sounds like an accounting detail, but I'm guessing it's much more than that. Why does the law force them to segregate that money?
Because the share premium account is treated almost exactly like the company's core capital. It is not profit you can distribute. And that's the crucial point for creditors and for investors.
You can't just pay it out as a dividend.
No. Companies can't easily use that surplus to pay regular dividends or, directors' bonuses. It's locked away and can generally only be used for specific capital purposes, like paying the costs of issuing the shares or issuing bonus shares to existing members.
So it's a mandatory protective buffer. It's cash the company raised, but the law stops them from spending it carelessly, making sure a strong capital cushion is always there.
Precisely. It protects the company's solvency. It assures creditors that the capital raised is stable. If they could raise 99 premium and immediately pay it out, the company's financial strength would just evaporate. This account prevents that.
Okay, now for the flip side. What about issuing shares at a discount? Selling a share for less than its nominal value. You said this is highly restricted.
It's legally disastrous, and for very good reason. The sources confirm that the UK regulatory framework sees issuing shares at a discount as a fundamental violation of the principle of capital maintenance.
But hold on. Why the absolute ban? Couldn't a struggling company argue that selling 50p shares with a nominal value of £1 is the only way to get emergency cash and survive?
They could argue it, but the law pushes back incredibly hard. If a company sells a share for less than its nominal value, it is instantly reducing its own stated capital base. And that capital base is the legal representation of the buffer that's there for creditors.
So you're weakening the security for everyone who's lent the company money.
You are, which is why, under most circumstances in the Companies Act, issuing shares at a discount is just prohibited. It's not allowed. And directors who try it can be held personally liable for the difference.
That distinction really sums up the whole protective philosophy, doesn't it? The company is forced to lock away surpluses, the premium to build capital, but it is strictly forbidden from doing anything like discounting that diminishes that core capital. It's a powerful regulatory tension built right into the system.
It is. It's all about protecting that capital base.
That was a swift, but I think a really insightful dissection of corporate ownership. Let's provide that final perspective for you, the listener. We covered the definition of ownership through different share classes, realizing that rights, not just price, are what matter. We then explored the legal framework for stability, that mandated process for altering class rights, which really empowers the minority. Third, we look at the legal formality of the allotment of shares, where preemption rights stop you from being unfairly diluted.
Right.
And finally, we detailed the strict control over pricing with the premium and discount rules, which actively enforce the maintenance of capital.
And I think the key thing to remember is that these technical rules, they aren't just arcane points for lawyers or accountants. They are the fundamental definitions of value, of risk, and of stability within the UK market. When you invest, you are relying on the integrity of this entire framework.
It's what gives you confidence.
It guarantees that the rights you bought are stable and that the company's capital structure isn't being sort of eroded behind the scenes.
Absolutely. Okay, so for your final provocative thought to chew on, if this highly regulated system defines the baseline for established companies in a mature market like the UK, meticulously defining rights, protection, and pricing to protect existing capital, how might the absence of such strict definitions change the risk profile when you invest in newer, less regulated instruments? Think digital assets, certain venture investments, where concepts like nominal value, preemption rights, and shareholder protection are either loosely defined or maybe don't exist at all. Is the certainty offered by the UK corporate structure worth all the regulatory overhead? Something to mull over as you continue your own deep dive.